Hey everyone, welcome to the 7investing.com podcast. Our mission at 7investing is to empower you to invest in your future. We do that by providing a ton of free educational content like this podcast and by offering a monthly subscription service where our team of advisors provides our 7 best ideas in the stock market each month for just $17. Today's a pretty exciting episode and conversation for me personally. We did a little poll on Twitter. I said I was on the edge of my seat, and we had a couple exact guesses of the people that I was going to be talking to. Really excited to introduce.
It wasn't that hard from that clue.
Some people were giving us way too much credit. They were saying we were going to talk to Warren Buffett and Charlie Munger. They were saying we were going to talk to Arthur Bergman and Joshua Bixby, but we had to settle for you two. You were. No, I told Warren Buffett and Charlie Munger, no, we were booked. So yeah, without further ado, we've got Peter Offringa, softwarestackinvesting.com. He is at Stack Investing on Twitter. And we've got Muji, who is, and Muji, I want you to tell this story, how you settled on this name. You are at Hhhypergrowth.
Hhhypergrowth.
With three H's, YPER growth.com and at Hhhypergrowth on Twitter. Peter, if you could just spend a few minutes introducing yourself and a little bit about your professional and technical background. And then towards the end of that, just what inspired you to get started investing in the first place?
Sure. So hi, everybody. Happy to be here. I'm Peter Offringa, and I'm the author and primary contributor to Software Stack Investing. But in terms of background, let's see, I got started in college in computer science. And after that, I've worked for a number of years leading software engineering efforts at a lot of different internet companies. Kind of started doing that in the late 90s, mostly in San Francisco. Examples are CNET, CBS Interactive, one of the Comcast properties, Zeusk, and most recently as the kind of CTO of the Airbnb of boating called Boatsetter. Roles are usually either VP of engineering or CTO. And I've worked at both startups and large internet properties. I guess through that career and through those roles, I've always kind of been responsible for leading like technology or software development and technology selection. So that's given me a lot of perspective on how to build high-scale websites, and really delving into decisions around databases, search, application monitoring, big data, analytics, CDN, identity, just security, all of those different things that go into, being a CTO and leading, efforts around supporting and building large scale websites. So that's really helped me kind of inform, the type of companies that I invest in. I got into stock picking way back in 2015. And found it was interesting because initially, I was just reading a lot of third-party blogs or sites like, Yahoo Finance, and we're familiar with all those names, and, was trying to glean information from those. And then kind of it clicked for me that maybe I would actually improve my returns if I tried to invest in things that I understood. And that's when I shifted into software engineering investment. And so that kind of spawned the idea for then, the blog, which is where, it kind of forced me to start kind of doing a lot of research on the companies that I wanted to invest in and then actually write about those. Kind of wrapping up the career though. So I worked as the CTO of Boatsetter through the end of last year, and then I left that company. And since then have been doing some consulting, some advisory board work, actually just started doing some angel investing, which has been really insightful. And then really just spending a lot of time on the blog. And then I guess on the personal side, I live in Florida with my wife. We have 5 cats. We try to get outside as much as we can. I guess this part of Florida, it's called the salt life. So whatever that means. And I grew up all over. My dad was in the Army, and I actually also spent 4 years in the Army. I went through Princeton on an ROTC scholarship. So I know, Austin, you were in the Air Force, so hoorah to you. And I guess I'll kind of end there.
Yeah. Thank you for your service, Peter, and your dad's service too. A lot of times, I think people don't realize the sacrifice and what families sacrifice and how much families support military members. So thank you to your family as well, because I know what that life is like, and I'm a big fan, obviously. So and real quick, Peter, how would you describe your investing style? Is it kind of long-term buy and hold? And then would you say, do you have more of a concentrated portfolio? Just rough number of companies that you own, and you list them on your site, but for people that might not be familiar.
Oh, that's a fair question. So yeah, I have a very concentrated portfolio. I usually hold 8 to 10 names, all in the software space, very focused on companies that provide tooling for software development teams, because that's really the things that I'm most familiar with, because those are the decisions that I had to make in the past. So I feel like I'm well empowered to kind of sort through the pros and cons, the competitive landscape, the value proposition. Examples of holdings in terms of even just largest to smallest are Fastly, Twilio, DocuSign, Cloudflare, Elastic, MongoDB, Okta. Those are my big names, and those are the type of companies that I invest in. In terms of things I look for, the main things are really around just a lot of the kind of less financial to start, and more along the lines of kind of fundamentals as it relates to the technology. So I really look at like the product suite. Customer use cases are important to me. I really like reading about like customer stories, and then trying to understand like how the technology companies solutions fit into that. Really looking at like developer adoption and developer almost evangelism and excitement around solutions. Large addressable market, that's growing, try and pick the leader or at least the disruptor in that space. I really like companies with like fast product development velocity, like a Datadog where they're cranking out like 5 products a year. Competitive moat, that kind of stuff. Strong leadership too, like technical founders, important to me. So those are the things I usually lead with. And then, the typical financial metrics, usually looking at revenue growth over like 30%, high DBNR, over 120, 130, increasing profitability. Like to see a company, that like going from maybe losing money to, that inflection point where they hit profitability, is really refreshing. Like to see Fastly do that in the last quarter. So I guess those are the kind of things that I'm looking for.
Great. And we'll dive into, you hit on a couple of things there that I think we'll come back to is kind of what we can watch for to see if those things are sort of trending in the right direction. But let's jump to Muji, and Muji, would love to learn and have you share a little bit more about your professional background, and then same thing. What made you think, what inspired you to get started investing?
Well, a very similar path to Peter. All the same, but different. I was a software consultant for decades. So this would be as a database and web developer. And so I was always immersed in the kind of those same technologies Peter was talking about: web development, database development, now into more clustered systems, and cloud infrastructure versus on-prem. So kind of have my hands in a lot of different directions there, but always around data streaming, data storage, data querying, data analytics, data visualization. So all those have kind of swirled around. I've been an investor also for decades. I've been an investor since before the dot-com era. I was actually living in the Bay Area at the time. All that was going down. So started investing then, and kind of was tech heavy, and ran right into a lot of the fun overextended companies there, and had a tumultuous little time with the dot-com era. but found the Motley Fool pretty early on. And so I've been a Motley Fool customer for a long time and been a subscriber to their newsletters and especially on their boards. So their forum, kind of an antiquated software, but there's it's a great place for a lot of like-minded investors. So I've been on the boards for years and always kind of collecting data and been a presence there. And that's kind of how I knew you, Austin, is obviously through the Motley Fool and now 7 Investing. And so I've been writing about tech stocks, I think, for a while now. I finally honed my investment and finally took it seriously. I was always relying on others for recommendations of companies. And that I did extremely well with that. Netflix in particular is one that sure erases a lot of other mistakes. I think I was up 140 bagger on that ultimately. And so I had a lot of success with some of those services, and but finally took things into my own hands. I reached a weird little nexus about a year ago, a little over a year ago, where I realized that because of my work, I'm a lead architect now. So lead data architect is my official role, but I'm a lead developer. I choose architectures, exactly as Peter was talking about, from more of a CTO role, but I'm constantly evaluating new softwares, determining the path that the organization I work for is going to go towards and start and hands-on with a lot of the implementation. And so I am, an investor, a software developer, and also a technologist, I consider myself, which is, interested in the future of technology, where it's all going. And so all those kind of swirl around, and I realized at my work that I am constantly explaining technology to the audience of customers. So people I'm building these solutions for and explaining how the architectures work, and also for upper management who's got to make decisions around it. And so I've always explained technology. And so I kind of finally figured out how to harness that in the direction of investing in the exciting companies I consider at the, kind of next generation of technology. And so I somehow wound my way into being adept at explaining things, I think, for non-technical folk. It's kind of my expertise on my blog. Diving into either product lines and explaining why these things crisscross, but I think more especially where, where the leverage is in the platform, where these things can go from here, how TAM is going to expand, as people add new product lines, or how they can take an existing platform and pivot into an entirely new direction. That's the exciting stuff that I'm most interested in as an investor. But all the things that Peter said completely resonate, But that's the naming of my blog, and my Twitter persona is Hhhypergrowth. That's the kind of companies I'm interested in. So you gotta give it that emphasis when you say it out loud.
So how did you decide on that? Because you're tough. Like, I know you and we follow each other on Twitter, but even in Twitter search, if I don't put in the 3 H's in Hhhypergrowth, I don't find you. So how did you decide on
found my own niche and it's not searchable? That's great.
You
I just like I like the word hypergrowth. I adopted it as part of my investing thesis. That's the entry point into my investment thesis, is hypergrowth. So it has to be a company that is growing the top line rapidly. And then from there, I look at, several other things after that, and I'm sure we'll cover that. So, I kind of adopted hypergrowth. That's the entry point into the companies I'm interested in. And
got it.
That became my avatar.
Yeah. So you both hit on something that I think is important, really for investors, right? And you both have been, and you have experience as investors, and you have experience investing through now 3 pretty large pullbacks: .com, 08, 09, and this year. So would love for you to just both of you share a little bit your experience going through those types of events and how, especially as tech investors or growth investors, however we want to, whatever bucket people like to categorize that in, how you were able to not get scared out of investing and continue investing in, some of these companies that people call overvalued, bubble, whatever the term is. How were you able to stay focused and keep investing after events like those three pretty huge and terrifying events?
Yeah.
It's temperament is everything. You have to understand that volatility is not risk. Volatility is a normal occurrence. Huge fan of Morgan Housel and his writings, and have had the pleasure of meeting him. He said at one point, this is normal. You can expect 15% pullbacks every 3 years. You can expect 50% pullbacks every 5 years, or whatever the exact ratio is. But this is a normal occurrence. It's a little bit, as we're finding this summer, a little bit of a popularity contest at times, I think, with certain companies or certain trends and waves. I try to look through all of that and look at the company itself. I evaluate the execution of the company itself, where I think the technology is going. I don't feel the need to go hop onto every hot name I see bandied about on Twitter. But if it's enough to grab my attention at a cursory glance, I will definitely investigate further. But I also, like Peter, carry a very concentrated portfolio now. I used to have 60 plus stocks. I've trimmed that down. That was years ago, but I've, over the last few years, trimmed that down to a much more concentrated portfolio. And because of that, I follow and know the companies extremely well that I hold. And so have confidence in them. It's not that I'm in love with them. I feel that they're the best places for my money, rather than scattering it around, 20 or more companies. But yeah, because of that, I have to be very strict, or I'm very strict about what I own.
Yeah, I would echo everything Muji said, as particularly around the volatility. And I guess what gives me confidence in like my portfolio and what I invest in is just confidence in the secular trends that are occurring. So like restaurant reservations, we're not going to go back to calling the restaurant. We're going to do that through OpenTable, e-commerce, the Zoom call, ride sharing, all of those things I think are going to continue to progress. And if we're invested in the companies that are either doing those things, or in my case, providing the picks and shovels or the technologies to enable them, then, I have confidence that those aren't going to go backwards. Those are going to continue. And as long as I'm thoughtful around the companies that I'm selecting and, certainly applying the criteria I talked about, then, if there's some near-term pullback because of something at a macro level, or, because, a bunch of, I guess, big investors or banks decides that multiples are a little inflated, that's fine. I mean, that, of course, that happened like in the second half of 2019 with all the SaaS companies, all the companies, the software companies we follow for no real reason, but I just kind of rode through that. And of course we came out better this year. So for me, it's, that confidence in the secular trends, and then and then understanding what I'm invested in, so that I think that is important for investors to try and to take the time to at least do the research to understand what are the companies that they're invested in, like what they do, why they're valuable, how their services compete. Because when the market, swoons and or goes down, and those companies, lose value, that's what's going to give you the confidence that, you shouldn't sell, that a Twilio or that a Datadog or that any of those names that we talk about are going to be just fine. And that when there's that multiple contraction, you have the confidence to kind of ride through it.
Yeah, picks and shovels. I couldn't agree more. I mean, I gravitate exactly towards that myself, Peter. The companies that are the building blocks for doing business at this point. And it's not just niche, a certain direction. These are very cross-applicable building blocks. Twilio, everyone needs communication. Everyone needs cybersecurity. every company has to adopt these things. So it's wide applicability in addition to being picks and shovels. Building blocks to being a business, not to being a tech business.
Yeah.
Yeah. All businesses, restaurants in my local community that had to shut their doors in their dining rooms because of coronavirus, in a week or 2 weeks, we saw them offering, delivery and order online and text updates, and all of that, like both of you are saying, was facilitated and built on top of things like Square payments and Twilio SMS text communications and all of that stuff. So it's incredible the adaptability and the innovation, flexibility, whatever you want to call it, that these software companies are providing to the businesses that build on them and our economy, right? Like, just think about the damage that would have happened to the economy if we didn't have software that could facilitate some of these changes so fast. You both hit on.
I'd flip that over just a little bit. Flexibility from the business's perspective, yes. Think on the other side. So I'm constantly looking through the lens of the technology side, obviously. Flexibility on the other side exists too. You've got instant scale capabilities now with cloud platforms that you never had before. And so when a company has 10 times the traffic in 2 months due to the pandemic, they can handle that. It's going to cost them more. They have to ramp up what infrastructure they do use, but it's all right there and available as a platform that they've already built their business on. They just are flipping a switch. It's a pretty incredible time.
It's a great point. Zoom would have never been able to handle the 10x increase in meeting participants if we weren't in the cloud era. There's this whole argument on whether or not these companies are overvalued and in a bubble right now. I personally don't think they are, but I'd love for both of you to just share your thoughts on the concept going around that we're in some type of tech bubble and there's about to be, this massive drop, just like 1999 and 2000.
Well, 99 and 2000 was kind of funny because back then, as I'm sure Muji recalls, those a lot of those companies, didn't even have revenue. I even invested in some, like CMGI was just like a holding company for a bunch of other companies that basically had like PowerPoints and ideas and maybe a little bit of software, but no customers. I mean, we're obviously far ahead of that. But I think your point relative to valuations and whether these stocks that we invest in are overvalued or whether we're in a bubble. I guess first I'd just look at history. I mean, post 2001, let's say, all of these tech providers, software providers, you talked about Amazon and Netflix and such, have generally grown. And yes, there were certainly dips at times, but over the long term, as long as you were invested in the right ones, you kind of generally were able to, see appreciation. Also, I think what is important about the type of companies that we pick, and is certainly always kind of a screening criteria, is what Muji was talking about, the revenue growth. I think that, as long as revenue growth continues to be, above, let's say 20, 30, 40% a year, then as you almost have like a good likelihood that the company, like you said, will grow into whatever, valuation is set currently. And yeah, I know we all look at like price to sales or, those kinds of multiples versus necessarily multiples off of profitability, like P&E ratios. But honestly, that seems to be what the market's been doing for a while. So, I don't necessarily have a problem with that. If they compress, fine. But, I generally have confidence that if, a company is growing at 30% a year revenue, well, guess what? In 5 years, it's just tripled in value, assuming that, those ratios stay constant. And so if they dip a little bit, okay, so instead of tripling, they double, that's still, a pretty reasonable return. It's probably going to beat the S&P. So I look for that, or that gives me confidence. And then I do agree with the notion that these companies do eventually need to be profitable. And that's why I think it is important, as we look at companies that while they're in this high growth mode, they do demonstrate, year over year, incremental improvements in operating margin, free cash flow margin, those other metrics around profitability. And as long as I see that, they're each quarter or each year, ticking up op margin by a couple percent and then eventually breaking even, well, that's great. Then I have confidence that over the long term, they're going to be profitable as well.
I would, yes, all of that. Completely agree and have a very similar take. Having been exactly through the .com era and riding this fun roller coaster called JDS Uniphase, where fiber is going to change the world and 99% loss later.
Pets.com.
Yeah, pets.com. Those are just a completely different realm. Those are all what I like to label aspirational. They're just a dream. They're a story. They're not investing in a company that is executing now. Whereas we've got proof right in front of us in the financials, these companies are executing. Zoom is not a dream. It is not something that's going to exist in the future. It just grew 169% and is likely to grow 250% in the upcoming earnings. It is a very exciting time for that company in particular. But other companies, Datadog, Crowdstrike, they're all performing incredibly well right now. They're not aspirational. However, in me looking at the technology and the technology story, I do see the potential for them to become more than they are right now. And so it's a good melding for me. And that's the picks that I'm most confident in, is when I see the operational excellence hit the ability to, what I call the ability to scale. So this is the signs of operational leverage. I don't care about profitability in particular. I don't really care about valuation because I think it's a little bit of an old-fashioned notion. It doesn't factor in scale and it doesn't factor in technology. And to me, these are a little more intangibles. So I look at financials, proof of the execution, but I need to see signs of operational leverage. And so it doesn't have to be profitable, but it has to be showing signs that they can swing profitable at a moment's notice. I want them to be using a higher level of expense now. If their modus operandi is land and expand, they need to be landing as much as humanly possible right now so they can take advantage of the expand. And so that's exactly what you want to see, is that the signs of operational leverage, but it doesn't have to be profitable to me. But then I look at the other side, the technology platform, and I need to see signs of scale there. I need to see customers flowing in rapidly. I need to see them spending more and more in the net expansion rate. And then I need to see ways that, and this is where it gets a lot more intangible, ways that their existing platform, like Peter, I like to see evidence of a platform, an ecosystem is developing. Ways that that platform can be leveraged in future directions. And to me, we just saw that with Cloudflare, bolting on a whole different category of cybersecurity, nearly doubling their TAM. That's exactly the kind of exciting points I'm looking for in evaluating the companies I own. So I see no relevance to .com at all.
Exactly.
Totally different era of pipe dreams and gambling versus we've got proof in execution. Certainly there's always risks, but the risks now are, because there's such wide applicability and these are the picks and shovels, it's going to be, catastrophic if there's risk, meaning that businesses have to be dropping like flies as their customer base. But the existing customers are going nowhere. They've adopted this platform. It costs less for them to adopt this platform. They're going to stay on that platform. There's no motivation for them to leave and spend more doing it the old way. So,
yeah, Kathy Wood, founder and chief investment officer of ARK, which I know all three of us are fans of. And if you've never heard of them, look them up. ARK Invest, fantastic stuff, very transparent. They do weekly, or maybe they're monthly webinars. And in the most recent one, she actually talked about how, because of how low interest rates are, the market in general is actually right around the kind of, over the last, I think 2 decades or 3 decades, the minimum PE ratio that's kind of the threshold when you compare it to interest rates. And so her argument is actually that with where interest rates are, how fast we're innovating, and what these companies have been able to do, and how fast the economy can adapt and grow and things like that, we're actually towards the minimum end of what that range could be. And they expect multiple years of kind of good outperformance or good performance from even the S&P 500. And then, so when you think about these types of companies, if we're investing in the right companies and we have the right behaviors, we should be able to do a lot better than that. So we have a bunch of questions for both of you, and we'll get to those, but I would love for each of you to share, and we'll start with Muji on this, a little bit about, you learn about a new company at a high level. How does that filter through your investing process, and how has your writing process and your own blogs, how has that impacted your investing process? Because one of the biggest things I want people to take away from this is, whether you start a blog or write or make your own notes or whatever, I think one of the best things you can do for investing is to begin writing your thoughts out.
Great question, Austin. And may I say, Austin Lieberman is a mentor. I've watched him, get into that realm he was just discussing of writing a lot, documenting his process, and it made me do the same. I saw how it made.
That means a lot. That means a lot, Muji. Thank you. I look up to you, so it means a lot to hear that from you.
So I I'm prolific with the writing. I'm verbose in describing things. I'm a note taker, and so whether it's work or studying something, I'm an engineer at heart. Okay, so I'm a software developer, and I research things all the time. So I jot down rough notes, and I kind of am constantly coming back and refining them into an outline, and I like to weave a little bit of a story certainly to my blog posts. And so, when I was on the Fool and on the boards, and kind of part of a community there of like-minded individuals that were all studying hypergrowth, and I really started adopting hypergrowth as an investment strategy, meaning hypergrowth is really the proven execution. This company is doing so well, they are growing hand over foot. But that's when I wrapped it up into my tech and research abilities. But I spend a lot of time on my posts. It's a very involved process. And then I'm also working full time, and I've got a family and young daughter, trying to remain involved in their lives. And I'm actually a little bit of an adventurer, so we go on trips a lot. I scuba and sail and ski and have fun with life as well. In my evenings, I kind of take the time to jot my thoughts down. And I completely agree with you. It is a rewarding experience just for any investor to jot their thoughts down and have an investment log of what you're doing and what you're thinking at a given moment, because things fluctuate so much, especially around earnings, and you can get a glimpse at how the company is performing. And then, product news and things are, as Peter was saying, these are very rapidly developing companies that have product lines that are being renewed. They're exploring new product spaces. They're moving quickly. But I keep jotting that down and just kind of refine. And once I've got the major points down, I've got a new company, I've looked at their financials, I see the growth that I like to see right off the bat, and I see the signs of operational leverage, meaning I see a nice swing in one of the operating margins or the cash flow margins. I can see it swinging. It's still negative, but at least it's trending the right direction. I want to see a positive trend. Once I've got that, I will dive deeper into the story and document kind of what the platform is. What is the ecosystem? Meaning here's the platform of their particular product line, and kind of the walls around what it's defined as. The ecosystem, which is how they interact with partners and integrate with others. And then where are they that picks and shovels play? What category do they fall in? Picks and shovels, are they development tools? Certainly my main categories right now: development tools, cybersecurity, observability, edge networks that are all new platforms that people can be developing their own applications on. That's data and storage, analytics. You know, those are all topics that I'm pretty tuned to and excited about. And so, you know, once I've got all those notes down, I kind of weave a story a little bit about how to better understand it. And it's really for me. So these are all notes for me. And I you know, with a little bit of extra effort, I package them up and am able to make them consumable by other investors, to get to know these stories, to get to know Elasticsearch. I had a huge write-up on Elastic. I had a huge write-up on cybersecurity, edge networks. You know, I like to explain what the excitement is around these particular platforms and technologies. And it makes me excited as an investor, but really that whole research process bolsters my own knowledge. I don't go personally use edge networks, you know, so when I write it up, I'm exploring the technology, where it stands, and then where I feel the potential is. And so, yeah, it's all kind of a win-win for me. I become a better investor. I keep track of my notes of my investment moves and why I'm doing what I'm doing. I keep track of the earnings, which Peter excels at. I love his earnings reports. And then these other deep dives into the industries like edge networks, and just to better explain why these are at the forefront of the next wave of solutions.
Yeah, and I guess for me, so yeah, I adopt a lot of the tactics that Muji does, and take a lot of the same approaches. I guess what I would add is, one, in terms of evaluating companies, I do, I guess, for me, leverage a lot of my past experience in terms of technology choices. So, and in some ways, apply the same paradigms to investing. So if back in the day I were, you know, running a website and, you know, we had identity as, you know, as a component of it. Let's say, you know, for a dating website, you have to create, you know, you have to create an account, you log in, you know, you get authenticated, you have access to certain permissions. We used to roll our own for that at Zeusk, but now there's this Okta solution. So for me, evaluating Okta is like, well, what is the benefit to my organization of, you know, taking an off-the-shelf identity management solution and through APIs incorporating that into my application? And how much is that going to cost me? And is there a value proposition there? And you know, what are the additional benefits in terms of maintainability and security and those kinds of things? And if Okta in that case, or any company I'm looking at, kind of passes that sniff test, and to me, that's almost the biggest validation of my interest in the company, because I know that other CTOs and other customers, you know, would probably have a similar reaction. You know, and I go through that process with, you know, any company I look at, whether it's like Elastic or Mongo or Twilio or Fastly. You know, you could certainly make the argument with Fastly and Cloudflare, like, okay, well, why would I move off of Akamai's, you know, DDoS solution or their WAF or their CDN, or why wouldn't I use CloudFront for CDN, which I used to, you know, 5 years ago, or at another company, but, you know, now there's this new CDN. Why is that better? And as a CTO, what you know, advantages would that have from a performance and from a cost point of view, and from a programmability and flexibility and all those criteria that then would make me a buyer, which then I assume would make, you know, other companies buyers. So that, at least for me, that paradigm, or that decision-making process, you know, has helped me with kind of investing as well. And then, yeah, there's the, you know, the financial metrics, and also I really like how Muji kind of modeled, you know, the consideration around the platform and extensibility of that, and operational leverage. Yeah, all of those things are really important points. As it relates to the writing, that has actually been probably the biggest revelation for me and contributor to, you know, my investment, I guess, performance and I would say success this year, is forcing myself to write about the companies that I'm invested in. And the reason is that if you have to write a thesis about a company, whether it's a review of the past quarter or simply why you're invested in it, it forces you, I'll say me, to really go into a lot of detail and research in terms of, well, the whys. Well, what do they do? Can you explain that to someone? Why is it better? How does it relate to this competitor? And those are things that, at least for me personally, I found I would just skip over when I was not forcing myself to write about this. You know, you just kind of take it for granted, or you might read somebody else's review and say, okay, well, so-and-so said, you know, Fastly was a good buy, so I'm not going to bother like spending the time to understand it myself. But like going into that much depth to really understand what these companies do and having to write it down, I think is a really good exercise. So sure, I don't think everybody needs to go out and start a blog, but certainly doing what Muji is describing, which is, I think every investor, if you're putting real money into a company, at the very least, I'd say every quarter, like write your own personal review of how they did that quarter. You know, and if you just store it on your own hard drive and don't share it with anybody, that'll make you a 5 times better investor, I think, because you're forcing yourself to really, you know, justify that investment for yourself and do the due diligence that, you know, is necessary in order to really understand what the company does. So I think for anyone, you know, who's wondering about like writing, you know, if nothing else, just write your own notes, like Muji said, and put it on your hard drive. And if you don't share it with anybody, it's still really valuable.
We can find this information and we can dedicate 5 or 10 hours a week or whatever it is. And when you look at the ROI on that time spent over, you know, multiple years of investing, it's hard to beat the return that you get on those hours of investing. So yeah, where do you find this information? Are you both in executive level meetings? Do you have companies telling you about their new products and their customers? Where do you get this info?
I do it the old-fashioned way. I investigate. First place I look, well, certainly, so ideas are, I'm always open to new ideas. And so Twitter's great for that. Some things will crop up. There's excitement about a certain company. C Limited is a company out of Singapore that there's a lot of excitement on Twitter. And so, you know, you start following certain people that can do those sorts of initial deep dives. That is a really good shortcut into learning about companies that are triggering my interest. The Motley Fool, as I mentioned, is another one, and services like yours, Austin, as idea spawns. But as Peter mentioned, I run a very concentrated portfolio, about 8 to 10 companies right now. And I've really taken over the past few years the approach of deeply researching and understanding those companies. So following the earnings. So I'm always looking at the financial statements, again, for signs of operational leverage or whatnot. The conference calls, listening to them or looking at transcripts, normally trying to do both. I don't normally listen to them live. I'll listen to them after the fact with the transcript so I can pause and take notes. It's a little hard to do when it's all rushed through in an hour. So I really trust on the company. I like to see the execution. I like to see it in the financials. So I'll spend a lot of time there in particular. When I'm investing in technology, then it's a little more wide-ranging, trolling through all their product pages, their marketing. I am not privy to those executive meetings and those secret handshakes, and those top secret clubs out there. If anyone wants to invite me, you know, especially if it's on a big boat somewhere, sailboat. But I'm not a user of many of these technologies. I'm tangential to them. I'm certainly in the data space, so I definitely utilize Elasticsearch, Elastic's product, MongoDB, some of those things. But and I'm an open source developer, so I'm constantly in the open source tooling. But as far as the applicability of products, say Crowdstrike, I don't have a direct involvement with that company. I don't know anything about them. I just see the execution first and foremost. Locked in. Wow, this company is performing extremely well. I need to know why. Then I start taking deeper looks, understand the technology. In the case of cybersecurity and technology, one thing I noticed in that particular company immediately is I was evaluating them with Elasticsearch. So as an Elasticsearch investor, Elasticsearch is getting into cybersecurity. One of the direct competitors would be CrowdStrike for endpoint protection, protecting the device itself. They acquired a company. And so I'm looking at these two companies and realizing, oh, this CrowdStrike has a secret sauce. And that is the fact that it is cloud-based, meaning it can look over the entirety of its customer base at once. Anything on-prem, AKA the legacy solutions, or anything really Elastic is doing is solely looking at just that company's endpoints, not the entire globe of endpoints. And so one inherent advantage that CrowdStrike would have over legacy players, and unfortunately in this case Elasticsearch and their endpoint acquisition, is that they can see and react over any breach across their entire globe of customers. And so they can spot it immediately, they can patch it immediately, and they can save every single customer at once with that patch. And so it's just a really interesting dynamic that you've got under this cloud paradigm of SaaS providers providing this tooling. They've got some inherent advantages that didn't exist in the days of old. You know, whereas 20 years ago, I was looking at products or looking at companies that were making products. And so they had to sell that number of products again, the next year plus more, again and again and again, whatever widget they sold. SaaS is a totally different paradigm where you are locking in a customer and they are recurring revenue every year unless they leave. And so it just seems to be a different time. I'm not going to say everything's different. Of course it's not. But I feel like these concerns about valuation and things like that don't take these things into account. The extreme lock-in that some of these companies have, and then how much they can scale from here and into new directions. It's all, I don't know, it's a very exciting time to be an investor, I think, in this particular space.
Yeah. In terms of, I guess, sources of information for me. So, you know, as I said, I kind of start with, or my focus is on the building block companies. So what I look for is sources of information about companies that are using those building blocks. So places I go are, first, there's a few podcasts I listen to regularly that are associated with software engineering. My favorite is Software Engineering Daily. That's been going for like several years, but there's a guy, Jeff Meyerson, who, you know, interviews kind of tech leaders from various companies. Like, he does a podcast every single day, and, you know, he asks them about like their tech stack and what technologies they're using and, you know, how they solve certain problems. So I listen to those and of course look for companies that are getting talked about as it relates to, you know, solving problems. Another interesting source of information I found is reading the company engineering blogs for a lot of the innovative, you know, companies that are more in kind of the consumer internet space. So my favorite engineering blogs are like Uber, Airbnb, like Stripe, Square, Shopify, Pinterest. So I read those engineering blogs. I also follow them on Twitter. They all have like Twitter accounts when they publish a post. You know, so an example would be like a couple of weeks ago, I was reading the Airbnb blog and I saw that they announced that they relaunched their Airbnb experiences product with the Zoom API in order to facilitate kind of hosts presenting an Airbnb experience to guests. And they've rolled that out to like 50,000 hosts worldwide. And I was like, whoa, well, that's probably good for Zoom. Maybe I should look into that a little bit more. But, you know, I've uncovered a lot of, you know, I guess, insight in terms of my investments by, you know, trolling those kinds of sources, you know. And then of course when I'm like preparing the you know, the blog posts or the quarterly reviews, you know, all that information is of course, as we know, available online. You know, I listen to the conference calls, you know, read the transcripts, go to the investor relations site, pull up the prezos, go through that. I mean, the company websites themselves usually have a lot of information about, you know, the products and, you know, their own blogs themselves. You know, like I read the Cloudflare blog and the Fastly blog like constantly. Every time they post something, you know, I'm like reading about that. And I think that if you get into that habit, you just like are constantly ingesting this information over time that just allows you as an investor to become more familiar with, you know, what the company is doing. That's more like once you've selected one. Another source of information that I found is just super rich is YouTube for tech talks. So again, I mean, this is specific to technology, but like there's a number of conferences like Velocity Conference, and there's several others where technology kind of thought leaders talk about different trends in technology. But what I also find is that a lot of the tech leadership from the companies that I write about or that we're talking about here, often speak. Like I've listened to, and it's very easy if you want to go like put Tyler McMullen, the CTO of Fastly, in YouTube, you'll see a whole bunch of talks come up, or Arthur Bergman, or I mean, the list goes on. And if you watch those talks, you get a lot of insight into how the company is thinking about the problems that they're solving and the approaches that they take. I even got, like, when I was deep into my Fastly research, I got into a bunch of tech talks from an organization called WebAssembly SF, which is basically a meetup in San Francisco to talk about WebAssembly. And Cloudflare and Fastly both present, at that meetup pretty frequently. So if you listen to those talks, you actually learn a lot about what they're doing. Now, I mean, it's time consuming, of course, but I've also found that to be a pretty rich source of information, because a lot of those, those conferences and those meetups, they actually publish the tech talks, and I find them very, very valuable. But I think, I agree. It's important to spend the time doing the research, whether you're going to blog about it or certainly if you're just making an investment. What is it, like Peter Lynch, kind of quipped, like, most investors spend more time like researching a washing machine or a refrigerator than like, the stocks that they're putting their life savings into. And I think in some cases it's like accurate. So I don't know, that would be my little bit of advice.
Yeah. Awesome points. And that's kind of, both of you hit on exactly what I was hoping. All this stuff is available to the public. You just have to be a little bit resourceful. Google it, the company websites. Cloudflare has their own, it's like a 24/7 TV network now, all kinds of stuff that's available. And two awesome resources, softwarestackinvesting.com and hhhypergrowth.com. Two other places where you can steal from the time that Peter and Muji put into studying all these companies and learn about them that way. Do you have something, Muji?
Yeah, I mean, that's the benefit, and certainly that's why I blog, is to let the investors who don't know those things, who aren't technically inclined, to be able to put some of those pieces together. So exactly like Peter was talking about. He's looking for those building blocks. He sees evidence of a company using those building blocks in ways he didn't anticipate. Those are always interesting to surface. Or what I was talking about with CrowdStrike, it's like putting pieces together because you're familiar with the technology deeply that, maybe the typical investor can't. And so I do, throw stuff out there to try and be part of people. I don't want to be an investment service, but I want to be part of people's due diligence for sure.
Yeah. Great point.
I'm skipping Peter's answer and going to go sign up for a bunch of Twitter blogs. The company blogs. That's a great
Giving
idea.
away all my secrets. Go ahead, please do.
I don't know if either of you have heard of this. I use feedly.com, and it's like $90 a year. You can create a feed, and I pull from Fastly, Cloudflare, every company you could think of, and it automatically updates your feed anytime any of those companies make a blog post, and then it provides you this, this streamlined feed where you can view it inside Feedly, and you can click to go to the company's external websites. You can tag stuff and tell it what you like and what you don't. It's a great service, and it might make both of your lives a little easier too, because I think we follow a lot of companies widely. So we're gonna get to Twitter questions in just a second. You both have been very generous of your time. This is one of the longest episodes, but I'm super excited about it. I want to put you both in a little bit of an uncomfortable.
Let's keep going.
A little bit of well, you have families, and I am thankful for your time, and it is late at night, so I want to be respectful of that. I'm going to put you both in an uncomfortable situation, as much as I've just complimented both of you, that I didn't really tell you I was going to do. So we're taping this on August 18th. There's a lot of the companies we follow have reported earnings. Some have not. So the companies that have reported, Datadog, Alteryx, Fastly, Cloudflare, companies like that. some that haven't, CrowdStrike, Zoom. From the companies that have reported, I would like each of you to tell me which one you're most impressed with and which one maybe you've got some, you're a bit more cautious on, or maybe some yellow flags, and tell me why, but you're not allowed to use numbers. So it just has to be, understandable terms, in general terms, in a story way. Why are you excited about a company? And then which one are you a little bit more cautious on maybe than you were before?
I'll let Peter go first.
Well, I'll take the easy one.
I got an easy one that I'm disappointed in.
Yeah, well, I think in terms of the one that I was excited about, obviously Fastly, I think that's because I like the accelerated revenue. I like the discussions around customer ads. I like the customer growth. I like the move towards profitability. I like the potential, the market potential. I know they didn't deliver quite at the level that I think investors were anticipating, but of course, it has gone up like at the time of earnings, like 5x year to date, or it had. So I'm still pretty bullish on Fastly, particularly going into next year. I think Q4 for Fastly is going to be really interesting. I mean, I'm not supposed to say numbers, but if you try and project what Q4 growth is going to look like, it comes in rather favorably. And I think Q4 is going to be big across the board for a number of the building block companies, primarily because of all the activity that is moving online. I think anything related to e-commerce in Q4 is going to benefit. I even sent out in my kind of weekly email an example of how there are these like investment funds that are going around buying all the bankrupted retailers like Pier 1 and Dress Barn and Modell Sports and a number of others, and they're basically shutting down all the stores and moving all the operations online. And lo and behold, Dress Barn just moved like 65 million a year of sales onto Shopify Plus. And they're going to probably do the same. This holding company is going to do the same with Pier 1 and a bunch of others. So you kind of wonder, well, what are the ramifications of that? But to answer your question, so I'm bullish on Fastly. I guess one that I'm a little more cautious on would be Datadog, and that's mostly around just the revenue kind of slowdown. I'm still confident in them long term, but I think going from 87% year over year growth to 68 to projecting 50% for Q3, and if you do Q4, it's like 38%. I worry about where that's going to land. I think over the long term, it'll be fine in the 40s percent growth over time. And I was encouraged by their product releases subsequent to earnings. But I'm going to have to kind of, dig into that one a little bit more before I kind of initiate a position. But I've been covering it favorably, for the last couple of quarters. But that was one where, I don't know, I'm a little more hedged right now than than kind of strong bullishness from before.
Yeah, interesting. So I'm pretty positive that Muji's answers are both going to be different than yours.
Somewhat similar. The company I'm disappointed with is Alteryx. They've really hit a wall. Some of it due to the way revenue is recognized upfront under 606 accounting rules. But I'm surprised how little strength they had going in. Certainly they were in impacted industries, but they even said impacted industries were buying them strongly. So they saw a lot of interest out of impacted industries as they were trying to improve operations and really slim down and using analytics for that. But I really like where they're going as a platform. A little bit of risk in where they're going as a platform because it's a pretty marked change in their technology. So they're going from pretty Windows-centric client server-based technology to more cloud-based and having a lighter designer on the browser. There's a little bit of risk there too. But I'm pretty disappointed in Alteryx all around. Datadog, I was actually pretty pleased with. The one thing I guess I would highlight for Peter is that they saw a lot of strength in their top customers. Where they saw the numbers change was that those top customers really streamlined their operations. And so because they're not usage based per se, but they are number of amount of infrastructure based, I guess I'd say. So, you know, the number of containers, the number of servers. So as companies really tighten their belts, I think they reduced the number of servers. They tried to do more with less. And so I think that really impacted Datadog a little bit in a surprising way, but I'm still pretty bullish on them. So I wasn't really displeased there. But I would say I am pleased with both Fastly and Cloudflare in general. Cloudflare doesn't quite have the splash right now. I think some of it's muted because they're bolt-on clone of Zscaler. So they've gone and developed a kind of end-to-end security for network traffic for enterprise users called Cloudflare for Teams, and it is a seemingly exact clone of Zscaler. Obviously, I don't use these products, but technology-wise, it works exactly the same as Zscaler currently does. And the setup is the same. They released that in January right into the pandemic and then made it free for users to really ease that transition. So a great move as far as you know, corporate brand and kind of the ethics of their brand. But they made it free through September 1. And so we're really not going to see the benefit of that until later. But they're showing such strength now and aren't nearly as usage-based as on their pricing as Fastly is. And so it's just, you know, remarkably solid company, that very solid performer. But I'm seeing some interesting things from their technology that Peter covered, their serverless week. Seeing some things there I like, and it's interesting watching Fastly and I just studied up on the Fastly's call last night. I'm a little slow to catch up on earnings reports, and even some shade was being thrown both directions from both of these companies, talking, you know, Cloudflare's pointing out speed isn't everything, which is Fastly's you know, claim to fame, really. And then Fastly really highlighting that their usage-based focus on their go-to-market, which is focusing on enterprise customers and usage-based pricing, is better than the small to medium business and focusing on a lot of little customers, which was obviously a shout out to Cloudflare. So a little shade being thrown both ways, because these companies are very much going head to head in their respective space. And both as next gen edge platforms. And please do not think of them as CDN's audience, because they are not. That is but one application on their platform. But that's the companies I'm most excited about. But it's not so much from this earnings. It's great to see Fastly has, you know, some momentum, but it's more the I mean, just massive potential. They're having success now, and I see a lot more coming for both companies in different ways over the next few quarters.
Yeah, I would definitely echo that. I mean, I opened a position in Cloudflare. Now it's almost now I've got my Fastly and Cloudflare on. Let's call it the edge compute play, but you know, that's like a third of my portfolio now. And I would agree. I think that it's interesting how Fastly and Cloudflare, I think, are attacking the huge market, but from different ways. You know, I mean, you could segment by, or look at how they segment by customer type. You know, Fastly focuses on enterprise. Cloudflare focuses more on SMB. Cloudflare has many more customers. Fastly has fewer. You know, in terms of the product positioning, you know, Cloudflare seems to be a little more network and it dabbles in enterprise security, whereas, you know, Fastly is kind of trying to be very clear that they're going after developers. You know, even the differences in kind of the serverless product positioning, you know, where Cloudflare is accommodative of many different languages and it's extending the, you know, the longer run times, whereas Fastly is trying to constrain that more to performance. You know, I think they're just going to cater to different audience segments, different buyers, different use cases, and both will benefit, I think. So I think it's going to be fascinating to see how they play. But I'm yeah, like Muji, kind of bullish on both.
Yeah, I do think the market got a little ahead of itself, certainly on Fastly for sure. But in general, it's been weird this season of, you know, every company is rising or every company is falling kind of with this market. Alteryx, which has an extremely disappointing performance, rose remarkably between quarters for who knows why.
Yeah.
I took advantage of that personally to exit most of my position. But I'm really excited. I do agree, Datadog, surprisingly had a little more headwinds than expected. I'm looking forward to the ones you just mentioned, Austin, that are coming up still. Crowdstrike, Zoom, both of those shown a lot of headwinds or tailwinds going into the pandemic. And so, the whole work from home is really going to feed into both of those. And so I'm really looking forward to the next couple of weeks of earnings reports.
Yeah. So interesting points there is that, a lot of people, I think, look at companies that could be seen as competitors or in the same industry as kind of it's a zero-sum game. But what I think I'm hearing from both of you, and I think you both own Fastly and Cloudflare, is that there's a way, and if the edge computing becomes as large as what these companies are saying, and I think as what us three think it can become, you could be very successful owning both of those companies. And there's plenty of room. And the thing that where I learned that from, or I guess the model I follow with that, is if we look at the big cloud vendors, Microsoft Azure, Amazon Web Services, and Google Cloud Platform, those are three monster businesses if they were just businesses by themselves, and they've all done extremely well. So if you think about the opportunity that's got to be there for Fastly and Cloudflare in Edge, especially as they're both disrupting and taking customers from Akamai, a lot of opportunity there.
I like to say in my write-up that CDN is just how they got there. It's just the first app that they had success with that funded their architecture, but they designed a better way to network the globe, and they're taking advantage of that and made it programmable. And so now it's one of the building blocks, and that's I can see why Peter likes them so much if he's around the building blocks, because that's what they are now. That they're only going to power the next wave of innovation for internet traffic, both directions. So CDN is very, coming from the core out to kind of published data that goes out to the scattered users. Whereas, both of these solutions can really be handling traffic from any direction. So it's pretty exciting.
One interesting difference that I heard in the two earnings calls, Cloudflare and Fastly, Cloudflare really emphasized that compliance could be a huge area for them. And I believe that's because their network in terms of points of presence and where their servers are and stuff like that is much larger in terms of raw numbers, and the countries that they have servers in is much larger than Fastly. And so what that means, and we're kind of seeing it with TikTok potentially in the US, is more and more countries maybe get concerned about doing business either within their own country or not doing business in certain other countries or not crossing lines. Cloudflare does have the ability to offer that compliance to companies because of how many servers they have around the world, to keep it, within those confines. That was my understanding. I could be way off with that, but that was how I took that.
So Cloudflare's in 100 countries. Fastly's in 55. Different number of POPs, but they got the same general strategy there. But I think what you're finding is that they're feeling each other out in terms of what their strengths are. Clearly, Fastly is really getting a lot of these next-gen companies, Shopify, Pinterest, TikTok. It's all these, really future-forward companies that are really at the cutting edge of software development right now and taking advantage of how data streams across the globe. Cloudflare is really taking the tact towards security focus. Although I will point out Fastly, one takeaway I had that I haven't written up yet, but they've mentioned security way more often in their recent blog posts and on the latest call than they ever have before. And there was a lot of hints that something's coming soon. But I think I actually gleaned this from Peter, that the CEO in one of the later interview presentations talked about how he's not going after point-to-point cybersecurity. He's more going after security in terms of app security. And so I think they are going to start taking advantage and maybe do something similar to Okta, start entering Okta space where they're doing identity management at the edge or something like that. So there's some clues in there about where they're going, but they're really staking out what domains they want, I think. And so compliance, perfect one for Cloudflare. They're in more countries, but they can hone services that are specific to the laws and data retention policies of every company. Absolutely. But
yeah, and
I guess with these is, I think they really get dismissed as aspirational plays. It's like, oh, it's great. It's providing something in the future, but I don't personally invest that way. These aren't aspirational bets for me. This isn't what, Fastly is going to have some magic next year with compute for edge. That's not a part of my thesis for Fastly at all.
Yeah.
I do want them to have compute. It's a necessary component for them, but they're having success today with their platform.
Yeah.
And so this is the combination I was exactly talking about at the beginning. I want to see execution today and ways to leverage that on the platform going forward. And both of those two companies have it in spades.
One of the really, and this is the last, I can nerd out on this stuff all night, but one of the really interesting things that Joshua Bixby, the CEO of Fastly, said when he was asked about kind of their sales approach in terms of small and medium-sized businesses is they almost use their partners. And so this is companies like Shopify. I think Wix
like
might
Adobe,
be a customer there.
Wix,
Adobe.
Wix, Adobe, Magento. Yeah.
To help them bring in the business and the impact from all of those different shops being opened up and stuff like that. So it's just really cool to see both of these companies know what they're good at right now, and then kind of like toy with the idea of either for Cloudflare expanding more into enterprise or with Fastly expanding more into small and medium business. But it's nice to see they're self-aware and they know what they're good at right now.
Very much so.
All right, let's jump into questions, and then we will end this thing, and I will let you go back to your lives and your families. I didn't want you to share a bunch of numbers and stuff because I want people to go to your respective blogs and see your numbers on the write-ups. I just wanted you to get people excited about the results of some of these companies. Muji, you said one thing. You're excited about Zoom. Peter, I think you're excited about Zoom too. What about when this work from home thing ends and everybody just goes back to work and life goes back to normal like it was in 2017 and 18? Isn't Zoom just gonna be, it's not gonna be important anymore?
Certainly to some degree. I mean, of course, once we have more human interaction in our lives, yes. Of course, that's part of what is making Zoom successful right now. But no, at the same time, it's not going to go down. It's a new world. People are realizing that in-person conferences to gather 30,000 people in a set location is extremely expensive for all the participants, and it's so much easier to do virtually.
I would add that I think people are maybe thinking a little one-dimensionally when they think about Zoom. They're thinking about an experience like this, or when we were in lockdown and, it's like, oh, my family gets on Zoom, or, all my college buddies get together on Zoom. And yeah, I mean, those use cases will continue to exist, or, oh, my companies work from home, and when we all go back to work, will we need Zoom anymore? But I think that misses the opportunity to an extent, which is that now that people are more familiar and comfortable with video interactions, I think we should think about the opportunity for video interaction to kind of transcend into other common day-to-day experiences. So dating is a good example. Why should you necessarily have to go on a bunch of physical dates, at least at the beginning, when you might be able to do some initial kind of screening over Zoom? That could be one example of, more usage of Zoom. I mean, telemedicine is, an obvious one, which is just, taking off substantially, and obviously Twilio and, Agora to an extent are getting into that. But I think that's a big opportunity for Zoom. But I think what investors should think about are what are other video driven experiences that could, then be leveraged through or I guess distributed to other channels. I mean, online shopping would be another one. I mean, if I'm like at Wayfair and I want to look at like how a couch looks and I can't, necessarily discern that from the pictures. What if I could actually do like a video showroom with, a salesperson, over over video and whether Zoom powers that or some other provider. I just think there's a big opportunity for this, for video streaming in general.
Yeah, I think their consumer user is the one that's going to drop, not the enterprise user necessarily. I think that's the one that went from 20 to 30% of their customer base. And so there's maybe a 10%, a little bit that might be ones to discard it a little sooner. But I think it's, Zoom hasn't been standing still. They've got Rooms. And so once things go back to more centralized workplaces, Rooms is going to start really taking off. They've got Zoom Phone, and they just this week, expanded that to a number of countries. Plus the fact that their APIs do provide those building blocks to being better integrated into more custom solutions for whatever verticals, exactly like Peter was talking earlier. So there's a lot of irons in the fire. And so I personally don't put much weight into the fact that they're, they might lose some of the consumer. That really isn't their primary focus anyway. They're not a consumer.
Yeah, I think they have a huge opportunity to displace phone and communication providers that are legacy, kind of like we talked about. It's just crazy how people just struggled to wrap their mind around how fast they've grown and how big of a company it is when they put it in that it's only video teleconferencing box. Awesome. Okay, so we're excited about Zoom and CrowdStrike, and I'm sure you will both cover those earnings once they come out, and we'll probably all be tweeting about it. So just look for any of that stuff to hear about how Zoom and CrowdStrike do. All right, let's get to questions. We got some good ones. You both have a lot of fans. Sam Sharples MT said, super excited for this one. Doesn't have any questions, but he could listen to YouTube ramble about edge computing and learn a ton. Can't wait.
I could too, Sam. I enjoy this.
At Ernest Kaplan, question for hypergrowth. For me, a big challenge with hypergrowth tech is getting comfortable the tech won't be displaced soon by something better, because you're paying for many years of growth in the future. So how do you assess that? How do you think about that?
It's ignoring scale. I really don't put much weight in valuations in general. It's the last thing I look at, and really don't play chart games at all. About entry points, once I'm interested in a company, I dive in. But we're individual investors. I'm not signing up to Cloudflare for the next 10 years. If something better comes along, I'm going to take a deep look at it. And so I do, because I run such a concentrated portfolio, I feel like, I got my ear to the ground as far as, like Peter was saying, following the engineering blogs. I do follow Cloudflare and Fastly. And so I'm kind of keeping up to date with where they're going and, seeing the tiff between them. And one of those two might emerge as the stronger eventually. But in general, I stay with the market leader, the category killer, or the leader as far as being the lead disruptor, like Datadog is being compared to Dynatracer or New Relic. I look for the leader, and I'm going to stay with them until I see evidence that they are faltering. And I feel like I would see that evidence in the execution.
Yeah, and I would just add, I think it's really important, particularly with some of these, companies that we follow that are what I'd call the independent service providers, who are often then, the question investors often ask is, well, it's just, one of the cloud vendors is just going to come along and kill that category. I still think that, first, talent is gravitating towards these companies. And as long as, the companies that we're investing in are attracting the best talent, you can tell by just looking at, the management team. That's going to define their success over time. Product development velocity, it's important to make sure that, they're continuing to crank out new innovations, new releases. Like I said, Datadog, they put out like 5 new products a year, it seems, or Elastic does a major release every 2 months. And if you dig into that, it's like a lot of stuff, so like that product development velocity is just going to keep them, ahead of, these big cloud vendors over time. And the focus, just staying in a niche and getting constant feedback from their customers. Again, it's just going to allow them to continue that loop, that feedback loop, that just drives the product development cycle.
Yeah, that's the funny thing is you watch, I was an investor in MongoDB last year, and there was a lot of FUD around Amazon entering the space, quote unquote. Mm-hmm. Amazon had actually been in the space for a number of years, which is trying to highlight it more. And the same with Amazon versus Elastic. Amazon came up with an open source version of Elastic that they had forked. These Mongo and Elastic were not standing still. They're not letting the cloud provider catch up. They're adding new features and products and solving things for their customers. And so it makes them hard to catch. So it really, it's going to take a new paradigm. It's going to take a new paradigm to upset them, not a competitor.
Yeah. I think there's something to be said for companies that they're focused on a few things and their livelihood depends on it versus like a MongoDB or a Twilio versus Amazon or Microsoft, who might have database products or edge products, but they've got most of their revenue comes from other things. They're just, not going to focus on it as much and focus on those customers as much. So brings us to a next question. And Peter, maybe your experiences in CTO type role would be good to answer this question. And this is from leaderless_SF. So I don't know if he's a fan of what's the leadership in SF. What possibilities exist of acquisition from market-leading edge players from the likes of Google, Microsoft, and Amazon? Basically just a question around what are the chances that, a Cloudflare or a Fastly gets acquired?
Wow. I don't know that I have a good answer for that. I think that acquisition is always kind of out there. I think that, I guess where a cloud vendor might find one of these solutions to be accretive, they might be interested. Certainly, there's always a possibility, and I'm sometimes surprised, when you look at like some of the acquisitions Salesforce has done, and God, even Datadog got a spike last week because there was speculation that they were going to get acquired. So I'd say it's possible. I guess as an investor, I try not to play to that. I would never make an investment because I think it's an acquisition play. And if it works out, like they get acquired for a price that, is greater than their valuation, great. Although it makes me sad because I usually like to hold these companies for many years. So in some ways, I'm hoping a Fastly or a Cloudflare or any of the companies we're talking about actually don't get acquired. I don't know if that's not a very good answer. Maybe Muji has better insight into how he thinks about acquisitions. Or
I don't see it being a fit. Certainly, I don't see any of those cloud providers being acquisitive in that way, as far as bolting on some new paradigm. That's not exactly a disruptor, but kind of sits alongside cloud. Certainly, they're going to take steps towards those companies. So, and AWS is already doing it. They have Lambda at Edge. Mm-hmm. It doesn't seem like a particularly compelling product and is extremely expensive from what I can tell. But they're going to take baby steps to be more like the edge companies rather than acquire the edge companies. But what they are going to lack is the programmable network. And so they're never going to be on par with Cloudflare or Fastly. And so, but there might be some use cases still where they've got existing customers and they just want, a little more compute closer to customers or something like that. But I don't see them being acquired, at least not by cloud providers.
Yeah, and I think a benefit of using an edge provider could be that you're not as reliant on your major cloud vendor, so their customers might prefer that they're standalone to AWS or Microsoft or whatever. So I think that's probably not, who knows, maybe they will, but not banking on them being acquired. And then also that competitive risk is maybe a little less than we think it is, because there's a lot of good reasons that customers would want a different edge provider than their cloud provider. A couple more questions we had from at Robert Weir MD. What do you expect the impact of 5G on the edge computing market? If we don't have a good answer for 5G specifically, just maybe
we have
like
a good answer.
future use cases you might be excited about for edge.
Well, I guess, I don't know, that's in some ways two different questions, but I mean, first 5G, I think will be good for edge. I mean, because really, if you think about 5G, it's really just increasing the amount of bandwidth between the cellular network, I'll say endpoint or entry point, and the actual cellular device. So it's making the amount of data that can be transmitted from someone's phone, into the entry point of the cellular network, increase by 10x. But it's not going to automatically increase the pipes between the edge of the network and the origin. Those are probably going to stay the same, or maybe they increase a little bit, but it's like 10 or 20% a year. So when new applications roll out that make use of that higher bandwidth, it's going to become even more important that content and compute and processing can be performed at the edge so that the user doesn't experience some sort of extra latency because they're waiting for their content request or their processing to go all the way back to origin in order to get a response. So I think 5G will actually be good for edge.
Yeah, I'd agree. I think it's going to actually hurt maybe CDNs a little more. Maybe not. Maybe it's a little more neutral there. But I completely agree with what Peter was saying. It's really lopsided. It's increasing the bandwidth way at the beginning of the request. But what it's going to do is allow IoT to really explode. It's the key that's going to unlock the potential of having way more devices be transmitting to the ISP. And then once it's at the ISP, then it's going to be on the regular backbones of the internet. So it's not, and it's not all the way to origin. So I think it's absolutely a positive for edge networks, in that something needs to be handling that increase in traffic on one end of the global communication spectrum. It can be handling it much closer to it, and greatly reducing the amount of bandwidth that is needed to the origin servers. Those don't have to scale up to the same degree that 5G is scaling the number of requests.
Awesome. Okay, we are down to our last two questions, and they both are related to Agora. Ticker symbol is API. I do not follow this company very closely, and I'm not sure if either of you two do either. Okay, good. So from @H to Psy, I'm sorry if I totally butchered that and announced and said it wrong. Is Agora, and this is for both of you, is Agora considered an edge play? I've seen it being compared to Twilio, Fastly, Cloudflare, and even Zoom. Which one would be a fair comparison, if any?
All of the above. I'll answer that one since Peter's drinking. I don't know if you know.
Water.
I have an opinion. I have an opinion, but go ahead, Muji.
I in my latest Edge Network write-up, where I kind of cover some of the basics of what Edge Network is and talk about some of the way the traffic flows that we were just discussing with 5G, with some really awesome hand-drawn graphics. I hope everyone liked those. Those are new to my blog style. I do briefly mention Agora. I consider them a specialty edge network, and so a little akin to a Zscaler. So Zscaler is a specialty network for cybersecurity point-to-point traffic encryption, and Agora is all about real-time streaming and video and audio streaming. However, they're a little like all the companies you just mentioned. So I do equate them to something like Twilio, in that they are a building block company. They are a set of APIs you can use to embed, like Zoom, embed video capabilities, but also audio capabilities into your products directly. And then they have built an edge network behind it to serve up that content. And so they are trying to take that away a little bit from Fastly. I think in particular is maybe a little more of a competitor because Fastly and Limelight are both a little more video focused than Cloudflare. But they are interesting play, and I've been researching them and might write them up further and may actually buy them. My one hesitation is that they're domiciled in China, and I am very hesitant to believe the numbers coming out of Chinese domiciled companies. So that's my one hesitation.
Yeah,
Otherwise,
I would echo what Muji said. I mean, they're interesting in that, you know, they essentially have, I mean, if you look at the architecture and the footprint, I mean, they have the equivalent of POPs, you know, data center presences all across, you know, the globe. And they currently leverage those to facilitate, you know, web RTC connections, basically video, voice, and real-time chat. And so I guess in that context, you could say, okay, well, those services are things that Zoom does or enables, and that's all done through APIs. And of course, Zoom enables video teleconferencing through APIs. So you could say, well, Agora could compete with Zoom in that context. Twilio does the same thing for voice and video. Of course, Twilio also has, you know, SMS, so it has ties into the actual physical networks, and they do email too. So, you know, the product offering is a little broader with Twilio. And then I think the interesting comparison is, yeah, what Muji was talking about with the edge networks with Fastly and Cloudflare, because the piping is the same. It's just that they're focusing on maybe a different set of use cases. And I think what is going to be fascinating is if we start to see, you know, more of these companies that essentially build these kind of networks of compute, you know, presence, and then leverage them for different use cases. You know, and in Agora's case, it's obviously being applied to video and voice. But I with all that said, I wouldn't necessarily immediately jump to the conclusion that Agora is going to be a big competitor for any of those companies we just mentioned. I just think that they're, you know, taking a different slice of the pie. And I think it's just interesting looking at how the market's evolving. And I agree with Muji, like I will take a look at Agora at some point. I tend to shy away a little bit from brand new IPOs, at least from an investment point of view, and then, you know, and may cover them, you know, after a couple of quarters.
Yeah, my two hesitations are, again, they're a specialty edge network. I like the more generalized plays. So Cloudflare and Fastly are able to build things on their own platform, exactly like Cloudflare for Teams. They built it on their own platform and can take and create new product lines from it, but also their customers are going to be doing the same thing, you know, in specialized cases, but people are going to be building products on those edge networks. That's also going to happen with Agora, but it's very specialized in terms of video and audio delivery. But it's that one little hitch that they're a Chinese-based company. There's headquarters in Silicon Valley and China, but their primary success right now is driven from Southeast Asia. In particular, I think it's the rise in e-commerce. There's a lot of e-commerce that has a live video interaction. And so I guess I'd equate it to the QVC style of selling in America, where they are showcasing a product and that gives people confidence to buy. So I think they're having a lot of success right now with that particular model. But yeah, I think like Peter said, let's wait and see what else they've got under their sleeves.
Yeah, no, then that is a good, important distinction from Fastly and Cloudflare, because Agora is not putting up a programmable environment. I can't take code in JavaScript code, WebAssembly code, whatever that is, and upload it to Agora's environment and run it there. And that's obviously what Fastly and Cloudflare are enabling, or, you know, a programmable network. You know, they're offering a service exposed through APIs that's targeted at video and voice and chat. So in that regard, it is distinct from the edge networks. Maybe something they decide to do in the future, but I mean, they're still pretty small. So, and that would probably be several years out.
Awesome. All right, we're winding down. Thank you both for your time, and we went way longer than I told either of you we were going to go, so you've been awesome sports. Follow these two at Stack Investing and at Hhhypergrowth on Twitter. And then there's links to both of their websites. We'll provide those in the show notes as well. I'll put you both on the spot one more time with another question I didn't prepare you for. And these are not investment recommendations. You two both own Fastly and Cloudflare. Tomorrow, you have to sell them and you have to buy something else. What do you buy tomorrow if you had to sell Fastly and Cloudflare?
Ooh. Well, my pitch was going to be for Elastic. I think Elastic's going to have an interesting trajectory coming out of 2020 into 21. If they can get back to the growth that they experienced in Q1, I think they're going to see a big multiple expansion in 21. I mean, they're sitting at what, a forward EV over sales of 12 right now, and yet I think going into 2021, their revenue could be growing back at 40 to 50% a year. So I'm bullish on Elastic for the long term. And I guess, if I were to buy something tomorrow, I think that would be, and I couldn't buy more Fastly or Cloudflare. I think that would be my answer.
Can I make it an existing company? Because I would just probably turn around and put it in Zoom and CrowdStrike. Those are the two that have my.
Yeah, I mean, that's fair.
As far as ones on my watch list, C Limited that I already mentioned, Agora is also on my watch list. Melly, which I have owned in the past, but is showing remarkable strength. All those e-commerce platforms like Shopify are doing extremely well. Shopify, Etsy, C Limited is a part of C Limited, and a part of Melly are just all knocking it out of the park right now. So those are all pretty interesting. How long they'll last is the question, but I do think it's a paradigm shift with e-commerce. So I'm starting to get out of my boundaries of pick and shovels plays maybe and start exploring. In particular, C Limited just had earnings yesterday that were really strong, or today that were really strong. So may establish a position there.
So thanks both of you again. Want to leave this open if either of you have any last things to say, things to share with the audience, anything you want to tell people where to find you. We've shared it a couple times, but thank you both for your time. I appreciate this, and this is fun. I think this is the first time you two have actually talked to each other via video, so that's pretty cool.
Video. Yeah. That was fun.
Yeah, super fun, Austin. It was ending on an interesting note. That's kind of where my thoughts have been lately, is that I've been so focused on the picks and shovels plays over the past year. That's where all the hypergrowth has been. But the pandemic has really brought hypergrowth to a lot of different industries, obviously impacted a lot negatively, but I was already in a mind space, and my portfolio was always towards these SaaS providers exactly because of how recession-proof I felt they truly were. They were the building blocks of other companies, and they're saving them money and giving them a new way of doing things like cybersecurity that they didn't have before. And so these weren't going to be easily replaced. So it's just interesting to watch a lot of other industries really catch these same wins. And so now I'm kind of expanding my horizons a little bit and starting to look beyond the pick and shovels. But thanks for having us. Super fun.
Yeah, I would agree. That was a lot of fun. It was great meeting you in person, Muji. Thank you, Austin, for sponsoring this. And, certainly a shout out to 7 Investing. I think it's great service. And really appreciate you just making the effort to kind of get people like us together to share knowledge with, the investment community. And, I'm just happy that, Muji and I can help other investors, navigate kind of what can be a pretty difficult market and help them, make informed decisions relative to, consideration for these software companies. So just appreciate you getting us together and I suppose getting the word out.
Well said.
Yeah, and that's what I want to end on, is just to both of you. I think you two are part of why now is a better time than ever before to be an investor, because people have access to great experts in fields that you two are sharing your information for free out there. So thanks for your time, and thanks for both of you for the time that you put into both of your writing. So let's end on that. Thanks everyone for joining, and we'll catch you next time.